What's going on, guys? Hope you're having an absolutely fantastic day. So in this video, I'm going to be talking about me shorting the Dow. So first of all, I'm going to walk you through my research and why I'm doing this. Second of all, I'm going to talk about my trade itself. And third of all, I'm going to walk you through how I know I'm right or wrong, the timeline, and also my game plan, right? So let's start off with performance, right? And before we start off, I want to say that if I'm right on this will be an absolutely legendary trade, right? So before we get into it, I just want to say, right, this is an extremely risky trade, right? So I hope no one just copies the trade or what, right? This is just research and my opinion and what I'm doing, right? So don't copy it blindly like a sheep, right? Because I do want to empower people to think for themselves and not copy my trades, right? So think if it makes sense, if it doesn't make sense before you do all these things, right? Because it's your money after all. So let's start off with performance, and the Dow is down about 7.4% from its peak to its current performance, right? So if we take a look, we can see that there was a huge rally before the end of the year. The Dow basically up 20% in a matter of what is this, 2 months. So you can see that the Dow is experiencing more and more volatility, right? And it's also outperforming the Nasdaq and also the S&P 500. And my theory for this is because the Nasdaq and the S&P 500 stocks have been selling off so heavily, right? That a lot of the money is actually hiding out in the Dow, right? So to me, that is not something that is sustainable long term, because eventually people will come out and take risks, right? People will want to be in Shopify, will want to be in Amazon, will want to be in Facebook and all these companies, right? So let me just give you an example, right? Would you rather be in Facebook or McDonald's, right? McDonald's currently is trading at around a 30 PE, and for the Dow stocks, generally, we use PE to measure them, and Facebook is trading at 10 times free cash flow, right? So you guys have to decide on that by yourself, right? But then again, if you wanted a 30 PE, why not just invest in treasuries? So that is another argument that I'm going to be talking about. So let's take a look at the Dow companies, right? So United Health, not going to comment too much because it's healthcare, not my area of expertise, but I gather it's not going to do too well in a recession, right? So Goldman Sachs, definitely no IPOs, no SPACs. If their trading desks take huge losses, but Goldman always manages to pull out miracles from their trading desks, right? But all these are handicapping them, right? Basically, no SPACs, no IPOs, no underwriting. Basically, very little people looking to raise money right now and finance deals, right? So I think coming off the tailwinds of 2021 and also 2022, I don't think they'll do as well as those here, right? Home Depot, definitely, real estate boom is insane. Now the bus is on the way, right? So Amgen, not going to comment. Healthcare, McDonald's is something that I have a very big pet peeve against, right? Because as I mentioned, they're trading at a 30 PE, right? And historically, they trade at a 20 PE. So you might say, what's the problem? Only 33% overvalued, right? But you only get to trade at 30 PE because you expect growth in your stock, right? And basically, what's going to happen, in my opinion, McDonald's is going to get smashed even in a recession, right? I'm talking about the stock itself, not the hamburgers, right? Because people will be still eating McDonald's. But the issue is, I think McDonald's is going to get smashed by two things. They have raised prices as high as possible. And second of all, they have also a lot of labor costs, right? And I think the labor costs will really eat into their margins, right? And they raise prices because of inflation, right? So next year, if there's a recession, what are you going to say? Inflation? There's not going to be inflation in a recession, right? Caterpillar has done well in the past 3 years because of the real estate boom. Not going to say too much other than that. Microsoft Corporation, basically, it's not overvalued. It's not fairly valued. It's slightly overvalued, I guess. But I guess for a company like that, it deserves a premium, right? But at the same time, Microsoft, is doing the best compared to all these other tech companies, right? And we do have to realize money is a competitive game, right? Because basically, if Facebook is down 90% and Microsoft is down 20%, and you do have to look at relative cheapness, but let's say Facebook is trading at 8 times free cash flow, what do you think these investors are going to do? They're going to take their money from Microsoft and put it into Facebook, right? So Visa, payments definitely not going to do very well in a recession. Volumes will go down, right? And Visa has been firing on all cylinders right now, right? Boeing, I think this could be a good or bad year for Boeing, because Boeing, basically, there have been a lot of issues with Boeing, and then travel is basically doing very well now, right? So maybe people need extra planes, right? Honeywell, I'm not going to comment too much on that. So I'm just going to go through the top 10, right? Because those are the highest weightage, right? That's about what, I think 40 or 50% of the weightage, right? And then I'm going to talk about the average PE for the Dow, right? And compare it with the current PE, right? So average PE for the Dow is actually 15.6, right? So you can see what is this Indu index. Basically, it's a Dow, right? I also didn't know. I Googled it. I was like, what Indu index? I thought it was DJIA, right? So if we look at the financial crisis, we can see that the Dow went down 54.5% from peak to trough, right? And some of you might be saying, let me first review the trade, right? Then you can understand why I would say this, right? Because my trade is basically puts on the Dow, naked puts, no hedge or anything, but it is used in part to hedge my portfolio as well, right? So that's something that you guys should understand, right? It's around 8.5% of the portfolio, and the strike price is 24,000 on the Dow, right? So that is just a strike, right? Not even the break even yet, right? And and the expiry is actually 19th of January 2024, right? So some people might be saying, whoa, are you insane? You think the Dow is going to fall like 35% for you to make money, right? No, actually, if it falls like 10, 20, 15%, I will still make money, right? Because what I plan to do is, if it has a sharp decline, right, then I plan to sell and basically roll the options, right? Basically have a longer time or a lower strike price, right? So in this case, higher strike price. Yeah, so you can see that this whole move was 54%, right? So what makes me think I can catch the peak move, right? Because I haven't even caught the peak move from here, right? So if I actually did this, I would have lost money, right? Because it's already 1 year, and basically it's an 8% move, right? Insignificant if you're buying this deep out of the money options, right? So I believe we are somewhat here, right? And you can see that, oh, how come you move the thing so much and it's also 50%, right? So that's just how declines are. The further it declines, the less percentage from the top, right? I don't know if I'm explaining that correct, but basically, if you decline 10% here, this from the top is another, let's say 15% decline, right? The same move is actually from the top 15%, but from here is actually maybe 20% or something like that, right? So percentage changes, right? So if you're enjoying the video so far, do help me smash up the like button, hit subscribe, and also hit the bell button and press on all, right? So this will really help out the channel, and also watch till the end, right? Because obviously you don't want to miss any important information. So let's take a look at consumer credit card balances, right? So you only use credit cards because you are running out of savings, right? And we can see that quarter after quarter that consumers actually have record credit card debt, right? And we look at the personal savings rate lower than the 2000 bust, lower than the 2008 financial crisis. So we can see that it's currently sitting at what, 2.2%, and deep in the financial crisis, it was sitting at 3.2%, right? So you can see what I'm pointing to right now. So let me take a look at the Dow stocks and what I think their fair value is, right? So you can see United Health. So I'm using average PE, right? So I don't have to count one by one, right? Because the weightage is all different and it's going to be very messy if I did that, right? So a company like United Health actually trades at a 25 PE or 26 PE right now, and its historical PE is 18 to 19, right? So you can see that actually it's not 100% accurate, right? But I think using the averages, it should smooth out, right? Especially with the weightage. So what do I get to? I get to that it's actually 138% overvalued, right? Basically 38% overvalued. And you might say, that's not much if you're betting it will go down 30%, right? So actually, at the end, basically, I'm betting that it will go down to fair value, right? Some people might be saying that. So are you like insane to bet that or what? And it would be pretty insane if it's just 39% overvalued, right? But you forget to price in a earnings contraction, right? Because a lot of people currently their forward earnings, right? It just marches up, 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 up. And you can see that all these stocks, for all the various reasons I mentioned, right, cannot have their earnings continue to march up, right? I'm almost 98% certain that next year their earnings will decline instead of climb, right? So a lot of downwards revision, and also a lot of these Dow stocks actually pay dividends, right? And if you pay dividends, it comes out of your share price, right? Which is a tailwind for my trade as well, right? So after factoring how much the earnings contraction is going to be, and obviously if your earnings contract, your multiple that you are willing to assign on these companies also contract, right? So I didn't even factor that in, right? So after the earnings contraction, I think it's around 82% overvalued right now. So I think if you factor in the earnings contraction, because it will not just fall to historical PE, right? Imagine if a company on here like Boeing starts losing money hand over fist, right? Maybe its PE will be negative. Maybe its share price will fall 50, 60, 70%, and you can't model it anymore, right? And that is why I'm saying that this still has a margin of safety, and it could be higher than this, but I'm just using this as a visualizer, right? So my personal opinion is that it will fall lower than historical PE for a time, right? So this trade really requires you to get out at the right time, right? Please don't follow me, right? This is not financial advice, and I am predicting for one of these events, right? Let me just show you one of these events, right? So maybe not as quick as the 2020 collapse, but if I get something like this, right, I would already sell out and roll out the options to basically more time and also less strike price, right? Oh, sorry, more strike price. In this case, it's a put, right? So this requires you to actually actively change your position, right? So don't follow me into this trade if you don't feel like you know what you're doing and all of that, right? So let me just summarize the video into a short conclusion. So first of all, the trade is basically January 19 puts. The strike price is 24,000 on the Dow, and I use a DIA to basically short, right? Because I don't have so much money to short the Dow. What am I gonna do? Short one share of the Dow options will cost like $30,000, right? So I use DIA to short it. And then second of all, the thesis is that we are entering a credit bust, right? That is the thesis, right? So I can be incredibly wrong on that, but all the evidence right now currently points to that, right? So I'm going to go with all the evidence and also my gut, right? So third of all, I'm not going to need the whole 30 or 35% move to make money, right? So if there is a 15% move down in the next month, right, I would already be long out of those options and having a higher strike and also more time, right? Because this, I do want to say that this play is limited to this 1 year to 1.5 years maybe, because I think that towards 2 years is already too far, right? So that's how I know whether I'm right or wrong, right? Because I do have a time for it, right? It's not like one of those plays that I can just forever put my head in the sand and say, you know, I'm not wrong as long as I don't sell, you know, I didn't realize any losses, right? So there is a timeline to it, right? So yeah, that's about all I wanted to share today. If you did enjoy the video, do help me smash up the like button, hit subscribe, and also hit the bell button. With that being said, have a fantastic day, have a fantastic trading year as it is already, and peace out.